All right, I've been wanting to do kind of a longer video on thoughts about inflation and just to kind of collect some of my thinking in different domains and what inflation is going to do to us as investors, as consumers, and how to think about it, how to work on our mental models about what may come. So hopefully this will be beneficial to investors watching this video. I actually am concerned that we might be in the very early innings of what could be a very long inflationary cycle. And so I guess I want to counsel you to start thinking very long term about certain problems, but also opportunities that may come in the coming years. And so I'm going to talk about it from the standpoint of an investor, from the standpoint of a consumer, and then kind of on political and historical models to think about. So this is going to be the structure of this video. So first of all, with investing, inflation it makes the game harder. It actually inflation messes with equity prices in a bunch of different ways. And so the first thing you kind of need to think about is, what is the nature of the pricing power of the stocks that you own? And what is the nature of their cost structures too? Because they're going to have different rates of inflation. There's going to be different pricing pressures to different degrees on different types of companies, right? So, there's sort of obvious things like a gold mining company is going to have much higher revenues if the price of gold goes up, which it should with inflation, right? But they're also going to have some cost pressure on their labor and on their equipment and so forth, right? Or if they're funded by debt, they may have higher interest costs if they have to roll any debt in the future. And so you need to think about these moving parts, right? And just speaking of another paradox, one of a number of paradoxes that show up in equity investing, in the past, it was generally assumed that consumer products companies are the place to hide during inflationary cycles. And I'm not sure that that's going to be true going forward. So, for example, if you think about this way of thinking, a company like Colgate-Palmolive or Gillette or whatever consumer products company, it's a low ticket item. The consumer, it's not a very big expenditure. The consumer is going to pay extra for this and not really feel it or notice. But I would say in prior inflationary cycles in the United States, it was different, meaning in the 50s and 60s and the 70s, we had pretty relentlessly rising living standards in the United States. Today, we do not have rising living standards. If anything, living standards are kind of flat to declining for a lot of people. Likewise, these consumer products companies are much more international, and that throws a wrench in things because other currencies are weakening even more than the dollar, right? So that may affect demand for these products internationally. So there's a couple of things that actually may mean that this sector is not necessarily a good place to hide. Now, I don't know. My goal is to just get you to think about what may be different or similar to prior cycles, right? And then another paradox is cash, right? What inflation tends to do is it makes equity markets more volatile. And so cash, weirdly, even though you might think cash is kind of a trashy place to store money because it melts like an ice cube, it loses purchasing power every year, you actually may want to carry extra cash because of the opportunistic value of having cash, right? You can seize an opportunity, or because you're holding extra cash, you may be all that much less likely to get shaken out of, say, a violent sell-off in the stock market. We all like to think that we're too cool to get shaken out in market panics, but extra cash helps you have more courage when the bad times inevitably come, right? So you may want to sacrifice some of the, sort of the melting, some of the loss from having cash. You may want to be willing to make that sacrifice in order to be opportunistic for some opportunity that may come in the future, right? And then speaking of consumers, I think consumer behavior is going to change in a lot of ways. It's sort of hard to tell how, but clearly it's going to be tougher to sell a house at a given value if the 30-year fixed mortgage rate is double what it was, say, a year ago, right? So the cost structure, the carrying cost of buying a house is significantly more than it was before. So homes are not going to sell as well as they did. And I wouldn't be surprised if interest rates continue to climb, right? So again, I don't know what's going to happen, but you have housing that is probably going to suffer. You're going to have other domains where, people are going to be having to pay more for cars because in general most cars are financed, right, or leased, right? So there's a funding cost, and the cost of that funding goes up. Likewise, companies that need to roll their debt, right? So again, counterintuitively, if you're a consumer looking at this not from an investing standpoint, but from like a household finance standpoint, you may actually want to reduce your fixed costs as much as you can, which means maybe paying down your debts to just eliminate that cost off your cost structure, and then you have that much more money that's reaching your personal bottom line, right? So again, more paradoxes, right? The textbook says you want to have more debt outstanding because you get to pay it back in weaker dollars in the future. And while that's technically true, that can mess up your cost structure in the short run, right? So again, this is not direct advice to any viewer. It's just to get you to think about these different puts and takes and seemingly paradoxical ideas, okay? Now, there's also, I think it's worth pursuing this from a sort of a political and historical angle as well. You want to think about what is your personal mental model for navigating inflation. And in order to have a mental model, you have to kind of know past cycles and what can happen and what has happened in the past, right? And I'm going to list some resources in the description under this video, some books that I recommend to viewers to read. But you're going to want to think about what will this cycle perhaps look like, and if it looks like a cycle that I've got some context for, what would I do, right? So usually for a United States investor, we have the 70s as one model to think about, a prior inflationary period, and the post-World War II, late 40s, 1950s era inflation that happened. I think, and again, I don't know, but I think the post-World War II model is probably the more apt model to use, where the central bank had very high, or the federal government had very high debt levels coming out of World War II, and they needed to inflate the economy and inflate away this debt relative to GDP. And remember, GDP is always in nominal dollars, right? But the debt is in also nominal dollars, but that debt is a stock of dollars that gets eaten away as inflation grows, right? And so if you can rev the economy and run it at, say, a high single digit or a low double digit inflation rate, in a few years, the size of the economy relative to your debt level is going to grow back to a normal level. Now, the 70s was a different period where there was kind of lousy economic circumstances and very high energy costs. Well, we have some things today that look a little like that as well. And so you can actually go back and look at what sectors did well during those periods and maybe use that as a lens for thinking about what you might do going forward. But the central idea here is you want to have your own sort of spectrum of mental models for what this cycle could look like and what you would do based on these different perspectives. And so the point is, get yourself smart on prior cycles of inflation. And then, I guess just to sort of wrap this up, the game's getting harder, right? Both the investing game, the household finance game, everything's getting a little bit more difficult. It's kind of, it's like the treadmill's just going a little bit faster each year, a little bit faster. You got to run a little bit harder to keep up. And, your capital, you need to extract more performance out of your capital to maintain that capital's purchasing power in the future, right? And if you have a salary or an income, you have to think about how to maintain the purchasing power of your salary, meaning by earning more money, for example, in the future. And then you have to be more efficient about your spending, right? And so you have to think about different socioeconomic tiers. The game is potentially going to get very, very hard. Some countries, the game is going to get really, really hard, and there'll be currency collapses. We've seen with Sri Lanka, for example, or Lebanon. You've seen already some destabilization of certain countries, and there's probably going to be more of that. Again, I don't know for sure, but you want to think about these things as possibilities, and then what that might do to equity markets here, and then how you might respond to that, right? So at the end of the day, the game is getting harder, right? And I've been thinking about this problem a lot. I thought I would sort of consolidate my ideas in this video, and as always, I hope it helps, and I thank you for watching.